Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 4th of July. I'm Daniel Lam, your host for the podcast. Yesterday, I was one of the presenters at our private bank's Greater China half-yearly client seminar. It was always good to think about what we discussed in the previous iterations of these seminars, such as the one 12 or 18 months ago, and compare them to the current situation. The standout in my mind would be the aggressive initiative to push real policy rates from deeply negative levels back into positive territory. Many central banks were raising rates at the fastest pace in decades to try to get out in front of the inflation crisis. For example, in the US, there was a swing in the real Fed funds target rate from roughly minus 5% to close to 1.6%, arguably the most dramatic policy shift in the last 50 years. Now, has monetary policy been effective in bringing inflation under control? Well, in the US, the UK, and also in the euro area, inflation remains stubbornly high despite aggressive monetary tightening. And in the US, the Treasury inflation break-even curve is actually remarkably flat, near 2%, from the 2-year to 10-year maturities. So that reflects a high degree of confidence that the Fed has not only defeated inflation, but that future inflation will remain anchored. However, inflation right now still remains much higher versus the Fed's target level. Now, the US rates market has now unwound all rate cut expectations for this year. This suggests a view that policy rates is likely to be kept higher for longer, and the Fed is likely to sacrifice growth in order to control inflation. Take a look at the recently hawkish rhetorics from the Fed, and recall our earlier podcast when we spoke about Powell's quote-unquote unhealthy obsession to bring down inflation to the 2% target. That is, in a world that is already fundamentally different, i.e., from the efficiently globalized world since the collapse of the Berlin Wall up to 2018, and then to the relatively siloed, multipolarized one since the beginning of the trade war. So, overall, the risk of over-tightening is there. Therefore, make sure there are stabilizers in your portfolio, such as gold, which was what we discussed in the podcast yesterday, and focus upon high-quality bonds, which is likely to benefit from any pullbacks in yields that may occur from potential rate cuts in 2024, when the US economy is likely to enter recession. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.